Markets showed optimism this past week as Wall Street awaits the Federal Reserve's anticipated 25 basis point rate cut on Wednesday. This would mark the second rate cut and easing of monetary policy since the aggressive tightening cycle began in early 2022. Tech stocks have been leading the charge. Treasury yields have edged lower in anticipation of the Fed's decision, while analysts remain focused on Chair Powell's forward guidance for clues about the pace of future cuts. The stock market for now doesn't seem to care. The market is setting itself up for a classic buy the rumor, sell the news event. This week, we're going to stay very focused on macro. We'll delve into a few tech stocks, but we're going to stay very, very focused on macro. The reason being is with the event coming on Wednesday, it behooves us to focus more on the macro picture because that's really what's going to be driving things as opposed to individual stocks. We will go back to individual stocks in upcoming weeks, but for this week, we're going to be very macro focused. What you have in front of you right now is a chart of the 10-year. Now you can see that the 10-year, the yield has been going down. We're almost at the April 25 lows. We're almost at the April 2025 lows. We're making our way down towards it, which is telling us that the bond market for right now is okay with the cut that's coming. So this is the 10-year. Let's look quickly at the 30-year. Same type of deal. It's not as dramatic as the 10-year, but it's also signaling that for now, the bond market is okay with these rate cuts that are coming down the pipeline on Wednesday. So why is this important? Well, if you're a tech investor, you want lower borrowing costs. You want the cost of capital to go down. Why? Historically, tech stocks trade at a very high multiple. Their PE ratios are very high. You're paying for growth. They don't really give off dividends. They don't really do buybacks. Historically, most of them don't. You're really paying for growth. So in a low rate environment, when you're looking for yield, you're willing to pay a high multiple for growth. If you saw that the 30-year as well as the 10-year were going up, then tech stocks will be getting slammed. So let's just look quickly at the 10-year because I know a lot of people like to look. If you saw the 10-year was up here, 43, in the mid 43s, 44, making a push in this area, then you would not see tech making new all-time highs, which therefore drives the S&P. What you're seeing now is that yields are coming down, which is a good thing. It means that borrowing costs are coming down. There will be some relief for consumers, whether it be in the mortgage space. Credit cards are a little bit more squishy, so to speak. They don't move as quickly, but mortgage rates are lowering, which enables the consumer to purchase a home. Right now, we have a glut of inventory. There are way, way more homes available for sale than there are buyers. That is a direct result of higher rates. Lowering rates will allow for the home market to pick up pace. We don't believe that that will benefit home builders. Again, our primary reason for that is because of the excess inventory that's in the system right now. We don't believe that home builders are going to benefit from lower rates as much as people would like to believe. Our primary reason, like we mentioned, is because there are a huge inventory of available homes for sale currently on the market. Right now, it is a dead market. It is thawing. However, it's not thawing at a very rapid pace. For a mortgage holder, anyone who has a mortgage sitting at, let's say, in between 3.25% to 4%, there's absolutely no reason for them to buy a home where rates are where they are right now. So they're not selling. So because of that reason, you sort of have a buyer strike. You need lower rates in order for that strike to get relief, for that strike to get some kind of relief where buyers will step in. The other thing that this will help is that the U.S. is sitting at record deficit levels. It's becoming increasingly expensive to service this debt with rates where they are. Now let's just get into the macro picture of the market and get into some tech stocks, and then we'll wrap it up. We're going to go with the following theme, and this is our theme for the week. We believe that where the market is right now, we're not saying it's a screaming short. We're not saying that it's a screaming buy. What we are saying is we believe that going into the event, the market is setting itself up for a classic Buy the rumor, sell the news. Everybody knows these cuts are coming. This is not a shock. I think we believe that the odds are approximately 98 to 99% that the Fed is going to cut by approximately 25 bips. We don't think it's going to be 50. We've heard calls for 50. We don't believe that that's coming. We think it's going to be 25. Really, in the press conference, we will be listening and focused on the language and where Fed Chair Powell believes the pace of cuts are going to be. Meaning, there are some that are calling for 3 cuts this year. There are some that are saying that they believe that Fed funds will be cut and be trading in the 3 to 3.5%. We don't know if that's necessarily in the cards. We think that's a little aggressive. We do believe that cuts will happen. We think that the Fed funds, we think Fed funds will be anywhere between 3.5 and 4. We think that's where it's going to live. We don't believe it's going to be sub 3.5. However, getting to the market itself, the market has already priced this in. If the expectation is that on the announcement that the market is just going to rip like there's no tomorrow, we believe that you're setting yourself for a very, very rude awakening. We think that the market's actually going to sell off on it. Not necessarily right away. We don't think that necessarily will happen on Wednesday after the press conference. We think it'll happen on Thursday and Friday. We think that the market is, again, setting itself up for a buy the rumor, sell the news type of event. There are a lot of things out there that are not great. Now, you could make the argument that last week on Wednesday, we got the revisions on the job numbers and that the country was actually going into recession. Recessions are usually rolling. Even if we were in recession, that data is so backwards looking that at this point, we're probably coming out of it anyway. The jobs numbers are not as we believe is important. One of the reasons that we believe that is because due to immigration policy where people are being asked to leave the country, we believe that the jobs market will be a reflection of that. If you don't have the people, do you really need the jobs? Especially with AI coming, we think that potentially the jobs numbers that we've seen in the past are probably not going to be reality moving forward. We don't think that it's going to be 250,000, 300,000 jobs. We think that those days are behind us. And that's just a result of population. We just think the population will be able to support that type of job growth. So we think it's going to be a significantly lower number moving forward. Not right away, but over time, we think that. As well as with AI coming, it's going to be removing a lot of jobs. So we believe that that's going to be in the cards as well. Inflation is holding in the upper 2s. So it's not at the Fed's target yet, which for now is a little bit of a challenge. We think that 25 basis points is more symbolic than anything else. The reality is it's not going to really move the needle. However, symbolism does play a part here. So S&P continues to move. A lot of why S&P is moving is because of tech, just plain and simple. I mean, tech is looking great. Cheap money. People will pay high multiples for growth. Tech is leading. It's the largest sector by weight in the S&P. It's making new all-time highs. So why would the S&P go? If it's approximately 35%, 33% of the S&P, it's the biggest sector by weight. The next leading sector is in the teens, is half of what tech is. So if tech is going, the S&P is going. So it behooves you to watch tech. Tech is your clue. If tech sells off, S&P is selling off. So just watch that. Let's get into some of the stocks. Apple did not disappoint. It was a pretty much classic. The announcement comes, they sell the stock off. The stock did recover. We originally had a target of about 2.25 to 220. Market basically got there. It got to a low of 225. So we really got to our zone and bounced. We believe this high is secure. We don't think the market's going to get here. We think that this is going to probably base out and just do nothing. The event was to a large extent a big fat nothing burger. So really there was nothing to write home about, nothing to get excited about. Looking out at some of the other names that are driving, we'll get to the big ones. So the first one we're going to get to is Microsoft. Microsoft had an interesting day on Friday, had an interesting week. Really, we want to see the market get above 515, 520. Even I would say this 516, 515 area is probably what you want to see for a move back up. 520 is going to be a challenge. This cluster zone over here is going to be a challenge. We don't think it's going to be moving with ease. I think it's going to take an earnings announcement to get this thing going. There was some news over the weekend regarding Blizzard. We'll let you Google that and do your own research for that. But there was some news that might put some pressure on the stock a little bit, just from a sentiment standpoint. Microsoft is okay for right now. A lot of these tech names are okay. Amazon had some news about AWS, so that kind of took a little bit of the wind out of the sails. Market is holding. They're not special. Right now, there's really no catalyst to move these things. Certain things are looking mind-blowingly awesome, and certain things are just eh. For right now, Microsoft is just eh. It falls into that bucket. What does fall into the special is Google. I mean, the stock just keeps going. This is a classic gap and go. This is looking fantastic. It's driving the entire tech sector right now. Google by itself is moving the entire nicey fang. It's moving tech. It's moving everything. So your key for right now is Google. As long as Google continues to hold, even if it doesn't push forward, as long as it continues to hold this upper end, and even if it doesn't take out the Thursday's low at 236 and a quarter, we think tech is still going to be powering forward. Again, moving into the event. After the event, there's a different story. Meta, again, it's okay. I mean, a lot of these things are okay. They're not awesome. NVIDIA, same thing. NVIDIA is holding. One thing to note about NVIDIA, it could be setting itself up for an island reversal. I know this is day 3. I get it. However, it hasn't gone anywhere. It could potentially be setting itself up for that. So just keep that on the radar. If it continues to base out and then goes, then the island reversal is off the table, but you could see it for Monday. It's just something to keep on the radar, but I wouldn't be playing for it. Okay. Let's look at Broadcom. Broadcom for right now, holding, doing well. Obviously some red bars. They're selling it off the open, but it's holding where it needs to. One of the things that's constructive about it is on this earnings day, it's still holding the high. So the high of this earnings day, even though it sold off, was 356.34. We're still holding above it. It's very constructive, as well as we're holding approximately 50% of Wednesday's igniting bar. So right now, Broadcom is looking constructive. Let's look at Netflix. Netflix, again, it falls into the bucket. Would have liked to have seen it hold 1200. Obviously, it didn't. It's falling back into the higher end of this 1170 to 1150 zone. It's really nothing special right now. It's just basing and doing not a whole heck of a lot. One of the names that we don't talk about a lot, but we're going to talk about it right now, is Tesla. Tesla had 2 igniting bars. Tesla looks like it's back in play. A lot of it has to do with the fact there was announcements that Musk is now fully focused back on Tesla and not in other extracurricular activities. So that's giving the stock a little bit of a boost. You have 2 days in a row of igniting bars. I wouldn't be chasing this up here. I think 400 are probably going to rest, maybe base a little bit, and then potentially go. But for now, I wouldn't be chasing this. If you're looking to trade it, wait for retracement because you missed it. Plain and simple, you just missed it. Okay. Let's look at Palantir. Palantir had a good day on Friday. This could be the start of a new move. Any move above Friday's highs at 171.53, I think you can buy it. And then you can just use 170, 169, 170 as your out. I think as long as it holds above this line, I think the market should keep going. One thing to note about lines and moving averages and chart patterns and all of these things, they're for you to see. They don't mean anything. If somebody needs to move something, they're going to do it regardless of your lines, your moving average, your Fibonacci, whatever you have on your chart, it's for you. If somebody needs to move something, they don't care. They're just going to move it regardless. It means nothing to them. Lines, all these things, they're not going to magically hold something up. It's a reference point for you to say, okay, if the market gets above this area or gets below this area or holds this area, then that's something that I can trade against. It's more a reference point. It's not exact. Okay, let's just end off quickly with the nicey fang. We mentioned Google was really the one keeping it up. It's looking good. It's again sitting near all-time highs. It's basing, it's holding well. For now, Google is really the one that's pretty much holding it up all by itself. We want to end off with one last thought, and we feel that this is an important thought. Be very, very wary going into Wednesday. Like we've said at the beginning, we believe this. The market is setting itself up for a buy the rumor, sell the news event. That doesn't mean the market is going to come crashing down. It's not what it means. However, we do believe that the market potentially could come back into this 60. We think it could hit the 21 day. We do. We realize that it's about 110 handles away, if not even lower. We think that this is going to be a buy the rumor, sell the news event. It doesn't mean that highs are in. We don't believe that the highs of the year are in. We think the market's going to keep going. There's really no reason for the market to pull back. In terms of this being the high of the year, we think that there's going to be multiple more highs of the year. We are getting up to the higher elevated areas of where analysts believe that S&P is going to go. 6,600 was one. We tagged it this week. However, we do believe caution is warranted going into the event. You can trade it. Just be careful. Manage expectations. Just keep this in the back of your mind. Buy the rumor, sell the news. 25 bips is already baked in. So when it gets announced, even though you're going to get some sort of constructive move up or thrust up, you could see a move down. Again, buy the rumor, sell the news. Thanks for watching. We'll see you on the next one.